The top business stories live from the Sky News City studio. Shares of BP surged by nearly 6% as the oil major records its second highest profit since 2012. Retail sales growth slowed in January as consumers continue to struggle with the cost of living. Plus, are robots the future for home deliveries? Good afternoon, this is Business Live with me, Ian King. BP has returned to profit after reporting a huge loss in 2022 related to its exit from Russia. The oil major reported a replacement cost profit, that's the industry's preferred measure, of $16.2 billion for 2023. That was up from a loss of $3.5 billion in 2022 when BP took a charge of $24 billion following its exit from the Russian energy group Rosneft following the invasion of Ukraine. On an underlying basis, replacement cost profit came in at $13.8 billion. That was down from $27.6 billion in 2022, but still BP's second best annual profit since 2012. BP also reported better than expected results for the final 3 months of the year, and it announced plans to increase the pace of its share buybacks. The shares have jumped by 6% at one point today.
What investors like about this is BP trying to strike a balance between continuing to pursue its energy transition strategy. It's one of the more aggressive of the big oil companies internationally in pursuing the transition strategy, whilst keeping traditional oil-loving shareholders happy with attractive and increasingly attractive return. So treading the middle ground and doing so quite successfully. New CEO, first quarter for him, clearly signalling no change in that clean energy strategy, but plenty of cash for shareholders.
Retail sales grew at their slowest pace in January for 17 months as consumers continue to struggle with the cost of living. The British Retail Consortium said total retail sales in the UK during January were up 1.2% on the same month last year. That was the slowest rate of growth since August 2022. Over the 3 months to January, food sales were up 6.3% year on year, but non-food sales were down by 1.8%.
What we saw is the early part of the month started reasonably optimistically as consumers were enticed out with those January sale bargains, but that didn't really hold up as the month progressed. So food did better than many non-food categories, particularly big ticket items.
Now, so-called last-mile delivery services, as provided by the likes of Deliveroo, Uber Eats and Getir, have become commonplace around the world. But those deliveries are less likely to come in future from couriers on bikes and mopeds and more likely to come via robots, such as those built by the Estonian-founded company Starship Technologies. Well, Starship, which claims to be the world's leading autonomous delivery service, already has robots operating in 80 locations around the world, including the United States, the UK, Germany, Denmark, Estonia and Finland. Today, it raised $90 million from investors, taking the total to date to $230 million. Well, joining me now is Tarvet Hinrichs, partner at the early stage investment fund Plural, which was one of those investing. Tarvet, good to see you today. You've backed this company in previous funding rounds. What made you want to commit more capital?
Looking at where Starship is now, they're the leading autonomous delivery company. So they've driven 11 million miles, and by now they're getting to a very exciting point. So they're at a point where the cost of delivery is beating that of human couriers. So it's just a natural point where they're ready for the scaling effect, and we're really excited to be backing the team. So they've been at it for 10 years, and it's still at the very early stages.
Now, what will they be committing this new capital to doing?
This will really go to growing the footprint, going from the current locations to double the location in the next months. And, there's a great pipeline of customers that are really excited to continue expanding.
Really interesting, though, that, the focus on VC over the last 18 months or so has all been about profitability rather than fast growth. Yet this is a business, on the face of it, concentrating more on growth just now.
I think it really comes down to looking at what's under the hood. And under the hood, looking at the unit economics of the business, this is looking very exciting. And every delivery made is done on a profitability level.
So is the business actually profitable just now?
On a cash level, it is not. But if you're looking at delivery by delivery, every delivery is profitable. So now it's really a question of getting to a scale where the company as a whole can break even.
So do you think it's close to becoming sustainably profitable then?
with the funding today, the company is on a path to being sustainable.
This is quite a treacherous area for a lot of business. I mean, Amazon, for example, scaled back on its robotic delivery business, Scouts. FedEx has dropped out altogether. What's enabled Starship to sort of plug ahead and build this position?
I think it really comes down to founders who are hell-bent on a mission to make something impossible happen. So Ahti, who is running the company, was previously the chief architect for Skype. So he's been building this for 10 years. And it's taken 10 years to get to the point where now we can make deliveries on a sustainable basis. So 11 million miles driven by these robots. That's far more, by an order of magnitude or 2 orders of magnitude, more than any competitor. That's why they're now at a point where they're ready to scale.
The viewers have been watching some of the footage while we've been talking. Why 6 wheels in particular? What makes that an optimum number?
I think it really comes down to how do we provide stability and how do we give these robots abilities to navigate any terrain, going up rocky terrain, navigating snow, anything, anywhere where humans can walk, these robots can be driving. How
do you protect the robots from being stolen?
I mean, obviously, theft is one issue, and these robots have to face all kinds of conditions. Bad weather, theft is really a question of making sure that it happens rarely enough so that it actually doesn't impact overall economics. Stealing a pizza box is not really worth it.
But what about the robots themselves? I mean, how do you stop them from being stolen?
They can make very mean noises.
OK. I mean, regular viewers will know you as the co-founder of Wise, and indeed we've spoken to you and your co-founder in the past. What makes Estonia such a great startup location?
I mean, there's something special in the seas there. That's all what it comes down to. But in reality, it's about having had an early start. Startups are part of an ecosystem game. Estonia was very lucky that Skype was founded in Estonia, and Skype was really built 20 years ago. Since the first exit of Skype, we've had many more startups that are coming from the original base of people who built Skype. So if we're looking at now, there was Skype in the 2000s, then there was TransferWise, which became Wise in the 2010s, then there was Bolt, then there is Starship, Zego, many companies. And so we can trace them all back to having a very good start of the ecosystem, which gives it a huge accelerating effect.
And how long do you anticipate Plural being a shareholder in this business?
We're here for the long haul.
Terrific. Tarvet, good to see you again. Thanks for joining me today. Some other business news stories for you now. And the co-founder of WeWork, the crashed co-working space provider, is looking to buy back the business. Dealbook, the New York Times' business blog, says Adam Newman expressed an interest in December last year in buying WeWork and its leases out of bankruptcy, as well as providing bankruptcy financing to keep the business afloat. It suggested he was being partnered by the hedge fund Third Point. Well, WeWork was once valued at $47 billion in private markets, but it collapsed in November last year, by which time its stock market valuation had declined to just $121 million. America's largest bank has announced plans to open 500 new branches during the next 3 years, even as rivals continue to close hundreds of branches. JP Morgan Chase, which already has nearly 5,000 branches, said it would be targeting US cities, including Boston, Philadelphia, Minneapolis, Washington, D.C. and Charlotte, North Carolina. The bank, which has opened more than 650 new branches during the last 6 years, sees branches as being a key way of providing customers with financial advice, rather than enabling them to carry out transactions. Now, one of the big themes in markets during January was the rush among governments and companies in emerging markets to raise money on bond markets. Some $47 billion was raised by governments alone, with the Ivory Coast becoming the first sub-Saharan nation to tap international capital markets in almost 2 years, while others issuing debt included Mexico, Indonesia and Saudi Arabia. Well, joining me now to talk about this is Marie-Jacques Cardouin, the Chief Executive of Edmond de Rothschild Asset Management France and the Global Head of Asset Management Sales. Marie, good to see you. We're not talking just about companies. I mean, emerging market corporates have also been raising money.
That's right. Hi, Ian, and thank you for having me on the show. They've been the big winner in 2024 so far, with issuances in January that were actually lower on the credit side for emerging market versus historical average, and roughly a fifth of the issuance for US debt. So scarcity has been definitely overwhelming to a certain extent, and we expect that it will continue to be the case because most of the emerging market corporates don't really have an urgent need to refinance themselves in dollars. They can issue in local currency, it's cheaper. They can get a loan. Some of them have actually bought back some of their paper. And the high expectations in earnings, better margins, and growth make it not so urgent to have to issue.
Well, that's the corporate side. What about the sovereign side? Why is there so much issuance going on here now? Is it just that countries are tapping into demand?
That's right. And I think that's something that we've seen across the board since the beginning of the year. It's been high activity across emerging market and developed market as well.
There hasn't been an awful lot of money going into emerging market debt funds, though. And if anything, there's been an outflow. So where's this money coming from?
That's right, not yet, but we're expecting that this is going to be an interesting play for investors this year, and we're expecting allocations to increase. The reason is, potentially lower US dollar and also lower interest rates. I think, until now, the central bank policies were such that it wasn't that attractive to invest in emerging market credit. But with the indication now that we've reached a pivot point in terms of monetary policy and the expectation that rates are going to go down, maybe not in March, but between March and the summer, let's say, and that makes it a more attractive asset class.
So part of this is the search for yield?
Absolutely. On average, would represent a 12% annualized gain. So an interesting, clearly, investment case for investors across the board.
You'll have to explain here. Someone watching this who doesn't have your depth of knowledge in this subject might say, well, hang on, Saudi Arabia is absolutely awash with money. Why is it raising debt on the capital markets?
So you're absolutely right. And I think when we look at portfolios and invest portfolios, we take some, views on countries, for sure. But certainly, when you look at the holdings in the portfolios, we spend a huge amount of time analyzing, the idiosyncratic or the specificities of each paper or corporate. So I think, there's a case for the asset class overall, but there is a very big, case to be made for active management, for stock selection, and in this case for, corporate selection. And that works continue to need to be made to pick the winners.
On the sovereign side, though, as a house, you're quite keen on Latin American debt. Why is that?
That's true. We have a history of investing in Latin America. We see quite a lot of value, and we've, historically been able to deliver performance to investors in the region. So we continue to have big bets on a lot of different corporates in the region. That's based again on earnings forecasts. It's based on strength of the fundamentals of companies that we're looking at, on the diversification of their business model, and also on the fact that they're, for a lot of them, quite international, and therefore they can mitigate the regional risk if need be.
Now, separately, another asset class in which you're invested right now is European small caps. Why that?
Well, for two reasons, mostly. We find that, currently there's a view in the market whereby European stocks in general are undervalued, which is not enough to make the case, but even more so small cap are undervalued because there is a belief from investors that they're more risky, that they have a higher chance to go bankrupt, which when we look at the fundamentals, it's actually, is not the case. They've outperformed large cap historically, not in the last couple of years. But we think that, going forward, there's a case to be made in an environment where investment interest rates are going to be lower, so they're going to benefit. We also expect PMI in Europe to increase at some point in the future, and they will benefit from that because they tend to be more domestic, and so they will benefit from that growth, if you like. And when you look at the M&A activity in small cap, premiums are around, between 30-60% versus the latest stock price. So, that is a good indication as well.
Bargains to be had then.
Exactly.
Mary, we've got to leave it there. We're out of time, I'm afraid. Good to see you this afternoon.
Thank you.
Still to come here on Business Live, we'll have a look at how the markets have done this afternoon. Don't go away.
I will always remember the atmosphere at the Shanghai protests. It was an electric mix of excitement, fear, and defiance. It's hard to express just how incredibly unusual these scenes are in China. I'm Helen Smith. I'm Sky's Asia correspondent, and I'm based here in Beijing.
A massive COVID wave is sweeping this city, but officially, almost no one has died.
We aim to be the best and most trusted place for news.
We found all the roads to one large cluster of facilities were blocked. Those we did reach were fearsome.
My biggest challenge is adequately telling the stories of the Chinese people, even when the authorities would prefer me not to.
Hey.
By the rules, we are allowed to film in the streets. I can't tell if I'm moving it or it's moving me, but it's a very strange feeling.
Those hills over there, that's Russia.
Is this military ready?
We are prepared to face every kind of challenge.
Fly Emirates, fly better. Fly Emirates, fly better.
Thank you.
Welcome back. Time for a look at the markets now. And European stocks have finished in positive territory this afternoon, following a big rally in Hong Kong and Shanghai overnight on the back of intervention from the authorities. Talking points this afternoon, as indeed it has been all day. UBS, Switzerland's biggest bank, down nearly 4.5% in Zurich. That's after it warned of higher costs. Well, here in London, the FTSE 100 has also finished in positive territory, up 0.9%, 68 points to the good. Some 26 of those came from BP alone. That's finished ahead by just under 5.5% on those results and the big share buyback plans in particular. Other gainers include the mining equipment maker Weir Group. That's finished up just over 4% highest, benefited from a lot of supportive broker comment of late. It's also burnished its environmental credentials today. Meanwhile, both Prudential and HSBC have rallied, benefited from the rally in Chinese stocks there. The Pru up nearly 4%. Not too many fallers to mention in the FTSE this afternoon, but Pearson has fallen by nearly 3%. That is on unsupportive broker comment. Outside the FTSE, Watches of Switzerland has rallied another 2.5%. That's on hopes that the UK government may restore VAT-free shopping for foreign visitors. You recall we were talking a lot about that on this programme yesterday. Over on Wall Street, a mixed opening. The Dow and the S&P 500 have opened to upside. The Nasdaq is currently slightly lower. Talking points today include the chemicals firm DuPont. Its shares up some 6% on quarterly results, while GE Healthcare is 11% ahead for similar regions. On the foreign exchange markets, well, the dollar's given up some of its gains from the last week. As you can see, sterling up 0.2% against the greenback. Euro also slightly ahead against the dollar. Pound up 1/3% against the single currency just now. Meanwhile, the oil price has clawed back some of its losses incurred during the last week or so. Barrel of Brent crude currently changing hands at $78.71 a barrel. That is up nearly 1% on the session. Joining me this afternoon is Priti Rathi, Senior Investment Director at Investec Wealth and Management. Pretty good to see you. One of the big talking points over the last 48 hours has been Novo Nordisk, of course, Europe's biggest company. It did a big acquisition on the manufacturing side yesterday.
It did. It's been taken quite positively by the markets. I think we've talked about obesity drugs quite a lot this year, but for Novo Nordisk and some of its rivals, a big hurdle has been whether it can produce enough drugs to meet demand. And actually, it's bought 3 sites from another company, Catalent, which are geographically very well spread out, one in Italy, one in Belgium and one in the US. And it should really boost its earnings, its potential for cash flow this year, and ultimately the share price this year and next, if it has the capability, which it now does, to produce enough of its obesity drug to meet the growing demand.
It paid $11.5 billion, which looks quite a steep price for a bunch of manufacturing sites. I guess this is more about what it's going to do for Novo's own cash flow going forward.
Absolutely, and the deal has been struck out of debt. It's quite a cash-rich company, so the market's not concerned about the amount it's paid, just actually providing the ability to produce and giving it full control over its manufacturing really de-risks its supply chain in this situation. So it has, as I say, been taken really positively.
Now, another company that's, we're in the thick of the earnings season right now in the US. One that caught your eye yesterday was Estée Lauder. And that's some big job cuts, but the share price has reacted quite well.
It had an announcement actually in December about cost reductions. And then it was quite unexpected that yesterday it announced a further cost-cutting programme, which is largely focused on headcount reduction. In addition to that, we heard the CEO talking about the company having reached an inflection point. A lot of its woes has been based on the Chinese and Asian travel market not being particularly buoyant since COVID. And actually, we're now seeing that change and take shape into what Estée Lauder have hoped for quite a long time. Chinese consumers are travelling more and picking up more skincare at airports, so on and so forth. So the rebound, coupled with the fact that the company have announced this big restructuring program, should really be a boost to the share price longer term. Internally, our analysts actually expect something in the region of $1.3 billion to be saved each year, which is quite sizable for Estée Lauder.
How would you look at Estée Lauder in comparison with its best-known international peer, L'Oréal?
I think the valuation is important, and the fact that Estée Lauder is much more shareholder friendly, with it not being family owned. In our view, the valuation of Estée Lauder is quite compelling. So we would say it's probably 20% undervalued based on what we're forecasting over the next 3 years.
Wow, that's quite punchy. Very briefly, Priti, we heard from Powell over the weekend, reining back on Fed rate cuts. What are your expectations for the year?
I think we've got reason to be quite cautious actually this year, Ian, because the market was expecting 6 rate cuts this year. And you're spot on, Powell spoke over the weekend and talked about not being in a hurry to cut interest rates and actually only factoring in 3 interest rate cuts. So if we have higher rates this year or fewer rate cuts than the market's expecting, as he indicated, that's likely to be a headwind for markets.
Well, we shall see. Pretty good to catch up with you again this afternoon. Thanks for joining me.
Thank you.
That's it from me. I'm back again with our next edition of Business Live tomorrow morning at 11:30. Hope very much to see you then. In the meantime, do stay tuned. Coming up next, it's Mark Austin with the News Hour and all the latest, of course, on the King's condition. Thanks for joining me this afternoon. Cheerio.